Yeah, yeah.
Good morning. My name is Gad Lebanon, and I'm Chief Economist North America here at the Conference Board. And welcome to our August edition of Economics Watch. Especially want to thank all of you who canceled their summer vacation just to be with us here today. Hopefully you have made a wise decision. So today we're going to talk. We're going to have the regular economic outlook focusing on the U.S. And I'll show you in a second. Our special topic today is job satisfaction. So we are about to release the results of our annual job satisfaction survey. There are some interesting results, and it especially fits well with Economics Watch because it turns out that a lot of the trends in job satisfaction are directly related to the improvement in the US labor market. So we are going to talk about that a little later. For those of you who are interested in CPE credits, just type your full name and email address in the space provided, and there will be 3 pop-ups for you to click OK on. And to get the credit, you need to stay online for the entire webcast, and the credit is available for live participation only. Also, another tip, if you have any questions during the webcast, no need to wait until the end. Just feel free to ask us and type it in the question pod box. I want to present my colleagues today that are joining me. First from Chicago, Robin Erickson, principal researchers in the human capital team and a frequent collaborator with the labor market team here in the economics department. Welcome, Robin.
Thank you, Gad. Glad to be here.
Robin is a co-author on the job satisfaction reports, and she will talk with us on that later. And here on my right, Frank Stimmers, Associate Economist at the Conference Board. Welcome back, Frank.
Thanks, Gad.
Good. So we will start with the US outlook, and as we sometimes do, before we tell you what we think, we are going to ask you what you think. So we have a polling question for you, and the question is, what is the most likely scenario for the US economic outlook in the next 6 months? Economic growth will accelerate, economic growth will remain the same, slowdown in economic growth, and recession. Again, 4 options, accelerations, the same, a slowdown, or a recession. So we'll give you a few more seconds to answer. 5, 4, 3, 2, 1, and let's close the survey. So I think we have a clear winner here, and that is a slowdown. So the majority of you think that there will be some slowdown in economic growth. Also, almost a third think that it will remain the same. The options of an acceleration or a recession are still a very small minority. Frank, does that surprise you, or?
No, I had more or less expected this. Maybe I'd expected some more people to say that they expected a recession, because we see, of course, a lot is happening in the news.
Yeah.
People are mentioning at least the R word.
Yeah.
But I think this is maybe in line with what we have also been talking about.
Yeah, no, I think that's true, and I'm glad that a small percentage is saying recession. This is not our base case scenario. We think we will avoid a recession in the next 6 months. Also, our leading indicators are not yet screaming recession. So good. No, at least in our audience, no panic no panic yet. So what do we think about the U.S. economy? So there is a slowdown. So if during 2018 the U.S. economy was growing at a 3% rate, we are now slowing down to around 2% rate, which sounds low, but the reality is that 2% is the new normal in the U.S. economy. If you take into account demographic trends and labor productivity trends, 2% is what we expect the trend to be for the next decade or so. So we are essentially back to trend after a stronger than expected 2018. We're also partly as a result of the weaker economic growth. We are seeing also a slowdown in employment growth that also relates to the recruiting difficulties in a historically tight labor market. But even because there is almost no growth in the working age population, even a more modest employment growth is enough to continue tightening the labor market and bringing back more people from the sidelines. So we expect that to continue. The positive part of the US economy is the consumer. We are seeing, after a very disappointing winter, we are seeing a strong recovery in consumer spending, and consumer confidence is also at a pretty high level. So and since it's 70% of the economy, as long as the consumer continues to spend, the U.S. economy will continue to grow, and that is our expectation. Where we are not seeing encouraging trends, as in the business spending on equipment and structures, that is taking a lot out of our economic growth. Also, business confidence is pretty low. But at the same time, we have a strong increase in government spending, a part of the Bipartisan Budget Act of 2018. We're now seeing the fruits of that, partly in defense spending, but also in other types of government spending at the federal, state, and local level. One of the reasons why business confidence is weak, beyond just concerns about the economy, is corporate profits are declining. The combination of slower growth and revenue growth, together with a tight labor market, a lot of labor turnover, and accelerating labor costs, are continuing to erode profitability. It's dropping quite rapidly in some industries, more than in others. But the direction is, if we continue in this trajectory, we are going to be back to the 80s in terms of level of profitability. So that's something that is weighing on the confidence of many businesses. There was a change in the Federal Reserve's policy from raising rates to lowering rates, and that is expected to continue. And this reversal in the policy led to a very large drop in long-term rates. The 10-year, the 30-year mortgage rates are all historically low. And that's already, we're starting to see some impact on that in refinancing and mortgage applications in general. So housing and other industries that are interest rate sensitive are likely to benefit from that. So our overall forecast is for staying at around 2%, but with the escalation and de-escalation and the overall volatility in the US-China trade dispute and other geopolitical developments, there is the fears of a more negative scenario are rising, and we will in the webcast mention those as well. So Frank, let's start with overall economic growth. We are slowing.
Yeah, indeed. So let me say to the audience, in the next couple of slides, we're going to give some more details to like the introduction you've just given. So in this first chart, we're looking at economic growth, and we see that 2018 was an especially strong year with economic growth above 3%, and we now indeed see this slowdown, something we had also expected. And it seems that it is going now closer to the 2% trend that we also expect is going to be the new normal. And I would also like to say it still seems a pretty solid number, and if you compare it to other mature economies and just the global economy overall, it seems that the US is still in a pretty good territory. Mm-hmm. So when we talk about the economy, often it's important to know what is happening in the labor market. So what we look at here in this chart, it is just employment growth, and we have here the red line representing the 12 months growth rate, and I especially want to focus here on the blue line, which is the 6-month growth rate. And then similar to GDP, you can also see that there's a slowdown in employment, more from close to 2% to now in a range of 1 to 1.5% of growth. Still, this will be more than enough to further tighten the labor market. I think when I talk about labor market tightness, I often like to look at 3 main components. So employment growth, which is putting more pressure on labor market tightness, but then we also have the growth in the working age population and labor force participation rates. And I think that the working age population is now barely growing. Labor force participation rates are now still slightly increasing. It's a very positive development, but overall, we see that we're still moving on this path towards a tighter labor market. So of course, when we talk about labor market tightness, one of the first indicators we like to look at that is the unemployment rate, and that is the red line here. And the unemployment rate has now reached a level that is as low as it was in the late 60s. Then in addition, we also often like to look a little bit beyond this unemployment rate and take some larger group into account. So that is what we call the broader measure of unemployment, the U6, where we also look at people that work part-time, but that actually want to make full-time hours. And we also look at people that are maybe not actively looking for a job, but they actually want to have a job. Mm-hmm. So when you still look at that measure, you can also see that it is as low as it was in the late 2000s, and that was especially, or the late 90s, I should say, yeah, which was a time when labor markets were especially tight, yeah, in the US.
Yeah, there is no doubt that also other measures like quit rates and recruiting difficulty measures, they are all suggesting a very tight labor market.
Right. And of course, a very important measure for businesses is wage growth, which we also now see that is accelerating.
Yeah. So, Frank, let's go a little more in details to some of the components of economic growth, and let's start with consumption, because there's some good news.
Well, you can definitely say that, especially in the last quarter, we see that there was a very big increase in consumption growth, and you can maybe say that consumption was driving GDP in the last quarter. And we see that it is more or less connected to the consumer that is still pretty confident. And as long as the consumer is confident, with consumption representing almost 70% or around 70% of GDP, then we can still expect a pretty solid growth number in economic growth. Then on the other hand, even though the consumer is doing pretty fine and disposable incomes are growing quite rapidly, at least in the first half of 2019. When we look at business confidence, this is actually a little lower, and especially manufacturing. And we also see that this is coming back when we look at investment. So what we're looking at here, that is the investment growth for the 3 main components, so intellectual property products, and we have the structures and equipment, the red and green line, and there you can really see that there's a slowdown now in the first half of 2019. And I think it's like, why is this happening? So this may have to do with some weaker business confidence. It can also have to do with the business world that is more aware of the slowdown in the global economy. It can also be that businesses are more uncertain about the future of the US-China trade dispute and that is going to happen for investment. So maybe they are holding off on making some of the investments that they maybe wanted to make, were they not this uncertain.
Mm-hmm. I wonder if on the structure part, if there is also a long run trend of like the increase in online shopping and the increase in the percent of people working from home, which reduces the need for both shopping centers and office buildings. So it seems like historically the growth of business structures is slower now than it used to be. So it may be part of that as well.
But anyhow, as we have now weaker non-residential private investment, if we actually look at the government spending, we now see that they have a little bit taken over the weakness in the private industry. So what we're looking at here, that is in the red line, the local and state investment by the government, and the blue line, and that is what I want to focus on, is federal spendings. And of course we had this bipartisan budget deal like 1.5 years ago, and we were already expecting that this would at some point show up in the data, and now we indeed see that this is showing up with federal spending being pretty fast. Of course, going into the future, we don't expect that this will continue, and that we also see here more slowdown when we look at government spending.
Yeah, the federal spending is one of the most rapid outside of periods of a recession. And during recessions, federal spending goes up because of unemployment benefits and other things like that. But now we are in a period outside of a recession, and we have a pretty rapid growth in federal spending, which is unusual. So, so maybe from a corporate profits perspective, what we are seeing now is a kind of a combination of two trends that are significantly squeezing a corporate profit. So what we have here, we're looking at the non-financial business sector, corporate business sector, and we're looking at two lines here. One, the blue line, which also relates to the left axis here. This is the share of wages and salaries out of gross value added. Gross value added is a kind of a measure that is a little like revenues. So you can view this as a proxy for the share of wages and salaries out of revenues. And also in the orange line, we see the share of corporate profits before tax, also of gross value added. So what we are seeing in recent years is that the share of wages and salaries is growing, and almost at the same rate, the share of profits is declining. And that is a direct result of the tightening of the labor market. We are seeing wages and salaries accelerating and growing faster than revenues, in fact. And as a result, corporate profits are dropping. And you'll see that we are already at about 10.5%. If you look at the profits line as a share of gross value added, a few more quarters in that direction, we will be back at the single digits, which is something that was more common during the 1980s than in recent decades, where the typical rate was much higher. So no CEO likes to see the profitability of their company declining. So this could have an impact on spending and trying to reduce labor cost and automate more, perhaps, to be more efficient and stop the bleeding in corporate profits. Another very important trend that is happening now and is also a result of the economic conditions, but also of the Federal Reserve policy, is what's happening to interest rates. So as you know, the Fed through 2018 was in a stage of raising interest rates, and then there was a sudden shift to lowering interest rate. And that change in Fed policy caused a significant drop in long-term rates. We see here the 10-year rates, the 30-year mortgage rates, and also corporate bond rates are all dropping very rapidly. And that's it's a bad symptom for the economy, but the impact of this trend is positive. In industries that are sensitive to interest rates, especially housing, the drop in interest rate is very good. In fact, I know someone on this panel that just refinanced their apartment. I'm not going to say who, but this is having an impact on refinancing and mortgage applications in general, and also could have an impact on other purchases that are interest rate sensitive. So that's something that could stimulate the economy to some degree. So Frank, what's the bottom line?
Well, the bottom line is maybe when you look at the top row. So let's first look at GDP. So for the remainder of the year, we expect that the GDP will indeed slow down to 2%, and that is also going to be the growth rate going into 2020. When we look at three main components, consumer spending, non-residential investment, government spending, we expect some regression to the mean. So some softer consumption spending, some softer government spending, and some pickup again, going into more positive territory for investment. I think one thing we haven't really talked about yet, and that's of course what is happening in trade. So when you look at exports here, in the first half of 2019, we saw actually a negative 0.5% growth, and we expect that this trend will continue for the remainder of 2019, which of course has to do with slower global economic growth. Today we heard that the German economy actually had like a negative growth rate, and if that happens also the next quarter, there's maybe going to be a technical recession for Germany, which of course has a large influence on the euro area. In addition, of course, there are many investors, business people that are closely watching what is happening with this US-China trade dispute. So besides this baseline forecast, we thought it is also good at this point to think a little bit out of the box, like not what we expect, that it will not be a lose-lose situation, it will not get out of hand, but to share some thoughts with our audience on what we think could happen if things actually do get out of hand. So here we so here we look at two major geopolitical events. So the first one, the US-China trade dispute, and I think it's just thinking about what happened last week. All of a sudden it seemed to escalate. Currencies were dropping. Tariffs, there were talks about higher tariffs, but then yesterday again it seemed to maybe slowing down a bit. Now it is maybe accelerating, so the news cycle is just going extremely fast. But let's say what happens if that continues and there are going to be higher tariffs and there are going to be more tensions between the US and China. Then at the same time we have another geopolitical event going on, and that is now the UK that has a new Prime Minister, Boris Johnson, and with him there's a bigger probability that the UK is going to leave the European Union without any deal. So meaning they go back and directly have to trade from the next day on with tariffs in place. So this could mean a further slowdown in the global economy, and of course we know the US is it's a large economy with a lot of domestic activity, so the direct impact from foreign trade may be limited. But if you think about what can happen to confidence, if consumers are seeing that prices are rising, they may start losing confidence and start reducing some of their spending, and especially for businesses that can happen the same, that investments are not going to bounce back as we do expect in our baseline scenario, but that we see actually further decline in investment spending. And then already with a global economy that is already weak, we're going to talk about not anymore about a 2% long-term growth rate, but closer to maybe even talking about recessions. Mm-hmm. And I think when we think about it, it's also important to realize when this does get out of hand, then it is very difficult to reverse. We have, of course, a Federal Reserve that can cut interest rates, but they don't have that much room left anymore. You can also wonder if Federal Reserve cuts its interest rates, say, to zero. If the environment is very uncertain, do businesses actually want to make the investment, even if it is cheap? Of course, it will stimulate a little bit, but you can still wonder, is it going to help? And of course, we have fiscal spending, which is often takes a long time before they can actually decide on what are we actually going to stimulate in the economy.
So yeah, so that's there is certainly more fear now in the markets and in the business community about a more negative scenario. But just to remind you that our main baseline forecast is for a 2% growth, and we don't want to over-scare you about other outcomes. So thank you very much, Frank. It was a great contribution. So we are now moving to the other part of our webcast, and that is our job satisfaction survey. So every year, in recent years, and for the, we had our first job satisfaction survey in 1987, so 32 years ago. And in recent years, every year we are fielding the survey again. It's part of our consumer confidence survey. Once a year, we are asking about job satisfaction of the respondents. We ask about their overall job satisfaction, and we are asking also about components of job satisfaction. How satisfied you are with wages, how satisfied you are with benefits, with your supervisor, with your people at work, with your commute to work. Over 20 types of components of overall job satisfaction. So we wanted to, I know we have an audience poll question in a minute. Actually, no, we'll get to it in a minute. So I just want to show you some of the main findings. Then we ask you what you think about your job satisfaction, and we'll continue from there. In general, 53.7% of workers are now satisfied with their jobs, and that's a 2.7 percentage point increase from the previous year. And that's one of the largest annual increases. We've seen job satisfaction increase for 8 years in a row. And it is very much related to labor market conditions, as we'll show you soon. So we expect the labor market to continue to tighten throughout 2019 and 2020. We also expect job satisfaction to continue to improve. We also can break the results by all kinds of demographic characteristics. So one thing that we'll show you a few slides on are the differences between men and women in both what drives their job satisfaction, and also what is the level of their satisfaction from different components of job satisfaction. We also look at the most important drivers of job satisfaction in general, and we find that it's future growth, communication channels, recognition, acknowledgement, performance review process, and workload. And those are important drivers, but unfortunately they are not ranked very high in terms of how people are actually satisfied with those components, which provides an opportunity for businesses to improve. As we briefly talked about before, the labor market is tightening, and what we see here in the blue line, that also raises the quits rate, the voluntary quits rate. So those are people who voluntarily quit their job, usually to go to another job. And it's that one of the main features of the improvement in job satisfaction is the fact that people who, in a time of a weaker labor market, had to settle for jobs that they didn't particularly like, now have, over the recent years, have more and more options to move to jobs that they like better, that fit better with their education level and their preferences. So that's one of the reasons why we are seeing an improvement in job satisfaction. So before we move forward, we want to ask you about job satisfaction. And the question here is, how satisfied are you with your job? And very satisfied, satisfied, neutral, unsatisfied, and or very unsatisfied. So, it's probably a question that could lead to a lot of soul searching and contemplation, but we are asking here to give us a quick answer. So let's say a few more seconds. 5, 4, 3, 2, 1. Let's close the survey. So, okay, so if the way we defined satisfaction and the way we got to the 53% in our survey is by adding the top two categories. So in this case, it will be 48. Oh, it just changed to 47 plus. Oh, okay, the studio, can you lock down the survey? Or maybe it's the studio that is voting now. So 50 plus 18%, 68% of the audiences and the studio are satisfied with their jobs. So this is much higher than the overall satisfaction. So first of all, congratulations for the audience. You seem to be happy with your jobs. And let's hope that continues, even if economic conditions deteriorate. Robin, any immediate reactions to the quick survey we did here?
No, I'm very excited to see that our watchers are satisfied with their jobs. So that's excellent.
Yeah, I wonder if we did this poll half an hour ago, if the results would have been different, or they just are very happy with this webcast and that improved their job satisfaction. It's
exactly.
Hard to tell. So, Robin, before I get you, I just want to show this chart, which is kind of the time series of our job satisfaction measure. So two things to point here. One is that we are, we can stay on this chart. Job satisfaction has increased for 8 years in a row. There has been, we had a change in the survey vendor and the survey between 2010 and 2011. So the results since 2011 are slightly off the ones that before. It's not exactly the same, but the difference is not very big. I think we can say with certainty that it's even 2018, after 8 years of continuous growth, we are still well below the 1995 and definitely the 1987 satisfaction level. Those were different periods in the US labor market. The employer-employee contract was different. There was much more loyalty on both sides. So a lot of structural changes happening in the labor market scene. So maybe going back to those rates would be very difficult, but still it seems that we closed the gap since the beginning of this expansion, and satisfaction rates are quite high. So Robin, one of the reasons why we care about job satisfaction is because it's related to other to things that are impacting workers, like employee engagement and productivity. So can you talk a little about that?
Sure. We wanted to show you all that job satisfaction and engagement are not the same. And while these two lines come from different charts, the blue line is the overall satisfaction, that's from our data, and the orange line is from Gallup's data on engagement since 2000. And you can see, even though the surveys weren't the same, the trend lines are basically the same, and engagement is actually lower than job satisfaction, but it is increasing. And it makes sense if you think about it, because someone could be satisfied with their job They're paying their bills, and they're doing their job day in and day out, and they're basically satisfied with it. However, employee engagement talks about when employees are motivated by their jobs. They're motivated to give discretionary effort, which means to go the extra mile. They're enthusiastic and they're excited about their jobs. And then they actually, there's definitely ties between higher engagement levels and higher profitability. So just wanted to mention that to everyone, that they're both going up, but they're not exactly the same thing.
Right.
And so,
Go ahead.
Got it. We'll go to I was just saying, do you want to go to the
Sure.
next slide, Gad?
Yeah, and there we see that some items, some components are growing faster than others, right?
Correct. And on this slide, you can see the top line, the red line, is actually job security. And so job security is actually the highest trend line for the last 6 or 7 years. The middle line is overall satisfaction. And then the bottom line is wages. So you can see that there's less satisfaction with wages than there is overall satisfaction and with job security. But the trend line, again, they've all been increasing over the last few years. And we believe that this is due to the tightening of the labor market, making it possible for employees. The chart that Gad just showed you around unemployment going down and voluntary turnover going up. When unemployment is down, employees feel safer to switch jobs, because if you take a risk when you change jobs, and if you don't like your new job, then there are others that you can get pretty easily. So we do believe that the trend lines have been going up because of the tighter labor market.
Right, and those.
If you go to the
we have a polling question in a second and another one, but just the one comment on this is that job security and wages are the two components that rose the most during the last 8 years, and those two components are the most related to labor market conditions. So it's not a surprise. I think we have another polling question right now. So the studio, okay. So we wanted to dig a little further into what you're satisfied with. So we are giving you 5 options here, and the question is, what components of your job are you most satisfied with? So you can choose one of the following 5: job security, people at work, interest in work, commute to work, and the physical environment in your work. So again, 5 options: job security, people at work, interest in work, commute to work, physical environment. So that is, those are 5 out of the 20 plus components that we offered in the full survey, but here we're just giving you a small part of that. So let's close the survey in 5 seconds. 5, 4, 3, 2, 1. Let's close it. So clearly the physical environment is not the main driver of the audience. None of you chose physical environment. A small percent chose a commute to work. So that's important. The first step of any job is to show up. So it's good that.
Well, and actually, there's some research that shows that if people aren't satisfied with their commute to work, they will actually leave.
Yeah.
So if an organization moves their location, or if a person decides to move, sometimes that commute actually does affect their satisfaction.
Absolutely. As a New Yorker, I can completely understand the importance of commute. But the big winner here, and also in our survey, it was one of the highest, if not the highest, is interest in work. 58% of you chose this one. And number 2 is people at work. And number 3, job security. So any immediate reactions, Robin? Are you surprised?
I actually am a little bit surprised, because when we look at our research, you'll see that the there's more of a spread. And so but I am not surprised at interest in work. I mean, to me, that makes sense. However, if we go to the next slide, you'll see it's actually the number 3 component, and well, it's actually tied for second. So,
well, actually, the studio, can we go back to the survey results for one more second, if it's possible? Okay, never mind. I mean, one big difference between the survey, the poll that we did with our audience, and the survey that we fielded is that here we force them to choose one option, and in the survey they could choose all that apply. So, so interest at work is, if you are forced to choose one, it is more likely to be the one, whereas commute to work, there are a lot of people who are satisfied with it, but it's not the most important determinant or thing that they would choose. So that's interesting. So, well, we are now seeing this again, and the very large increase, a very large number who chose interest in work.
Right.
So if we move to this slide. So Robin, those are the top components in terms of satisfaction.
Right. Well, and the interesting thing about them is if you look at them, commute to work, people at work, interest in work, physical environment, and job security, you can actually see the first 4 employees actually have a pretty big choice, right? When you choose a job, you are choosing whether or not you're going to like your commute to work. You're choosing at work who you want to be friends with. And you're choosing a job that interests you. And so often, after mergers and acquisitions or reorganizations, when there's changes to jobs, employees actually, decide to leave because they're not as interested in their work or they don't see any potential. So we thought it was very interesting just to see the items here. And you can see actually, as Gad said, we did allow them to pick all that applies. So there's a big spread here, but these 5 things were the 5 most important, the five items that workers were most satisfied.
And let's look at look at the ones that are least satisfied.
Correct. Yes. So the ones that the workers are least satisfied with, you can see they're least satisfied with their bonus plan, followed by promotion policy, performance review process, educational job training programs, and recognition and acknowledgement. And very often these are things that an employee doesn't actually know that much about when they join an organization. And so the bonus plan is typically based on the organization's profitability, but it also depends on performance review and whether or not your manager likes you. The promotion policy, again, that becomes very political in many organizations. So we did think it was interesting that the 5 job components that workers were least satisfied with were basically items that were definitely out of their control.
Yeah.
So if you go to the next slide, we asked our members in the survey whether or not they felt jobs were plentiful in their area, or did they feel that jobs were hard to get. And so the gray bars here are a number of the job components. The gray bars are those who feel jobs are plentiful, and then the red bars are those who feel jobs are hard to get. And there were just a few interesting findings. Overall satisfaction, there was a 30% difference between those who feel jobs are plentiful and those who feel jobs are hard to get. The other 2 items, job security and wages, which we mentioned earlier, those economic drivers, there's a 29% difference between those. And then on average, we just thought you'd be interested to know this, there's about a 22% difference between all of the other components that are listed here. So definitely people are more satisfied when they feel that jobs are plentiful in their area compared to those who feel that jobs are hard to get.
And the gaps, again, are the largest in job security and wages, which again are components that are especially related to labor market tightness. Robin, there is a question from the audience. If you can maybe elaborate a little more about the difference between job satisfaction and engagement as a concept.
Sure. Well, job satisfaction is actually part of employee engagement. It's an important component as well. But if you think about, there are an awful lot of workers who go to work just to pay the bills. They don't love what they're doing. They don't feel inspired by what they're doing. And their goal with their job is to make a better life for their family, make sure their kids can get to college, make sure that they've done better than their parents. And yet there are some people in jobs where they also are inspired by the mission and the vision and of an organization, and they're willing to do extra work. And that's really what we look at as employee engagement. Are employees willing to do more when they're asked to? If a colleague leaves, are they willing to step in and cover for them? Or if they're on maternity leave, for example. And in terms of engagement, we look at, are employees inspired to be there? Do they believe in the mission and the vision? Do they actually feel like their job is one that they want to go to every day at that company? So that's sort of how we're looking at the difference between job satisfaction and employee engagement. We actually have a lot of research on employee engagement, if you're interested. We've been doing a yearly series for the past 5 years on the DNA of engagement. And so feel free to take a look at that research.
Thank you, Robin. So Robin, we also see some pretty large variation in job satisfaction when we look at different states. Now I know it's hard to kind of find or to tell exactly what's driving those differences, but what are your main takeaways from this map?
So our main takeaways are that if you look at the key, people are least satisfied in the red and pink areas, and they're most satisfied in the light blue, and then the most satisfied in the dark blue. So obviously we think that there's more research that needs to be done here, but we would hypothesize that job satisfaction is typically higher in states that have faster population growth. And so you can see, there's higher job satisfaction toward the Southwest, decreasing job satisfaction in the Northeast. And if you start to look at where people are moving to, there is a little bit of a correlation there. So that's our initial hypothesis. And Gad, I don't know if you want to add anything else.
Yeah, the South Atlantic is also an area with relatively fast population growth. It could be that in places with a lot of new population, there is also new businesses, new job opportunities, more dynamic economies. So that may support job satisfaction more than in areas that have a stagnating population.
So I'm in Chicago and you're in New York, and it doesn't look like either of our states are terribly satisfied with their jobs.
Yeah, I wonder if
I guess we have to do a better job.
I wonder if in New York, if we could break it down between the New York City metropolitan area versus the upstate areas that are pretty depressed because of the movement out of manufacturing. If we would have seen differences there, but that's for some other webcast in the future. Yeah.
Exactly.
So, Robin, so in addition to looking at the kind of levels of job satisfaction, we also try to measure what components drive overall job satisfaction the most.
Correct. And so you can ask someone what, we looked at 23 components of satisfaction, and we asked them which ones they were most satisfied with, and we went through those just a few minutes ago, the top 5 components that employees were satisfied with and the bottom 5 that they were least satisfied with. But then we also asked in the survey, what components matter most to your satisfaction? And so we were able to look at by doing a correlation analysis, we were able to look at and see that the top 5 job components that matter most to employee satisfaction are potential for future growth, communication channels, recognition acknowledgement, interest in work, and performance review process. And so the interesting thing with this chart is that these are areas that we believe organizations can definitely think about improving because these matter most to employees. So we have some more suggestions around business implications a little bit later on, but we just wanted to show you that we did a different analysis, and don't be confused, but the first one was how satisfied currently are you with these components, and then this job correlation is, how important are those components to satisfaction. And you can see here the top 5. Go ahead.
No, so in this slide, we kind of combine them both, and maybe this is a pretty complex chart, so maybe, Robin, you can take a minute to explain to our audience what we are looking at here.
Sure. So if you look at the y-axis, those are the percent who are satisfied. Sorry, not those who. Those are the component satisfaction, the one that we just talked about. And then if you look at the x-axis, it's the correlation to overall job satisfaction.
Or the driver, or the driver.
The drivers, exactly, yeah, the drivers. And then all 23 items are listed on this. It's really interesting. If you look dead center, there's wages. So it's just something that's interesting to think about. People don't typically leave their jobs only because of money. But let's go through the chart quadrant by quadrant. If you look at the bottom left, you see it's low driver, low satisfaction. And so there's not a lot that's, in that real bottom left, but there's a few items that are still there. So people, they're not as satisfied with some of those items, like the pension retirement plan, and they're not as big of a driver. If you go to the top left, the low driver, high satisfaction, you can see that commute to work, vacation policy, and sick leave, people are fairly satisfied with those because those were decisions that were made when they joined an organization. But they're not as big of drivers toward their satisfaction.
Yeah, especially commute to work. It's, I think, the weakest driver of job satisfaction, and it's one of the ones that people are most satisfied with.
Yeah. Satisfied with, exactly. The right hand, you can see high driver, high satisfaction. That's the magic quadrant, right? All of these 2x2 charts, they have a magic quadrant. That's where you want to be. And so you want to be with the things that are high drivers and that employees are satisfied with. You can see there's people at work, physical environment, quality of equipment, job security, and interest in work, and the supervisor. However, the interesting thing is, and why there's a green arrow there, is because employees are only moderately satisfied with those things. There's space for employees to improve on for those. And then what we think is actually really interesting is the bottom right quadrant. And those are the high driver, low satisfaction items. These are drivers that we think organizations should really spend some time on and try to improve. So briefly, there's workload, performance review, recognition, acknowledgement, potential for future growth, and communication channels. We're going to talk about those in just a few minutes in terms of in our conclusion. But I realize we are running out of time, so why don't we just go to the next slide, which just talks about the differences in gender that Gad had mentioned originally. It's not surprising to us, it might not be surprising to you, but men and women value the satisfaction components differently. And so when we look at the current satisfaction levels, that's what this chart is. There are some differences in the drivers as well, but this is just looking at the current satisfaction. You can see that women are more satisfied with people at work, the workload, communication channels, and the work-life balance. And men are more concerned about compensation issues, retirement plan, bonus plan, promotion policy, and wages. So, and actually I misspoke. These aren't the current satisfaction levels. These are the drivers of satisfaction. So, apologize for that. But you can see, again, women, they care about the people at work, they care about the workload and the communication channels and whether or not their job works for them, as oftentimes they have more parental responsibilities. And then, men are actually factoring in compensation more.
And Robin, we didn't add here the accompanied slide here about the satisfaction levels, but from my memory, it was very much correlated with this slide. So, for example, wages and bonus plans, which are the types of components that are more important for men, they were also more satisfied with compared to women, and vice versa. For example, work-life balance is more important for women, and they were indeed more satisfied with. Yeah.
No, and it makes sense, right? It goes to show that people are choosing jobs that actually that have those components, those job satisfaction components that they're most interested in. So if you go to the last slide, this is just some suggestions for some organizations. So remember that bottom right quadrant, and we suggested that you try to move everything up to the top right. Well, the first one was around talent mobility, and we actually just published a report called Total Talent Mobility that talks about all the different ways, the strategic purposes of talent mobility, and how you can demonstrate to employees that there will be growth potential for them. The second suggestion is around considering the transparency of communication channels. You should do an audit. Find out which of your communication channels are working the best, which ones are the most transparent, and then determine whether or not you should make improvements. The third one is, if you don't already have one, you should definitely create an employee recognition program. And some organizations have actually implemented an employee-to-employee recognition program where each employee is given a certain relatively small number of dollars every month, and they can, or applause awards, or a way to recognize their fellow employees. And that has actually been very successful in many organizations. The fourth thing here is to ask employees if they're inspired by their performance reviews. And if they aren't, ask what would inspire them. So there's been a lot changing in the world of performance reviews. And Gallup research shows that only 14% of employees are actually inspired by their performance reviews. So we suggest, no matter what it is that you're doing, in your next engagement survey, ask your employees if they're inspired by their performance review, and then leave an open space for folks to tell you if they're not inspired, what would inspire them. And then last but definitely not least, in this tighter labor market, many organizations are operating with unfilled positions. And so we think it's really important that organizations monitor and decrease employees' workload when necessary, and foster more work-life balance. Try to help employees try to figure out how not to be on call 24/7 and not to work on their vacations. That's something that a lot of us Americans do, and we probably shouldn't. So with that, Gad, I'll turn it over to you for any closing thoughts.
Thank you very much, Robin. I think it's a very interesting work, and a report on that would be ready by the end of the month. So if you're interested, you'll be able to download the report from our website with the information you've seen here and much more. Just a reminder that next month we'll have another cycle of Economics Watch, and including a webcast in which I'm going to host my colleague Janet Howe, senior economist at the Conference Board, and we're going to talk about realizing and measuring digital potential in addition to our overall economic outlook. I want to thank Robin and Frank for joining me today in a very interesting webcast. And to our audience, thank you for joining us today. And if you can take another minute from your vacation and tell us how you think we can, what you thought about the webcast, and any feedback or suggestion. This would be greatly appreciated. Thank you very much for joining us, and have a great rest of the day.